Hey, welcome to the Guarantee Retirement Guy show. So today I'm going to talk to you about the MVA. So what is an MVA? It's called the market value adjustment on annuity contracts. A lot of times this can be confusing and people wonder, well, what is the MVA? How does it affect me, right? I thought I wasn't supposed to lose any money on an annuity. Well, you don't lose money on fixed annuities as far as the market is concerned. Now, if you were to take the money out early, like all of it during the surrender charge period, then you will incur surrender charges. Typically, most annuity providers, at least a lot of the ones that I look at, will allow you to take up to 10% out without having any penalty whatsoever. Anything above that, you're subject to whatever the surrender charge is, whether it's 10%, or if you're in your fifth year, it might be 5 or 6%, and then it just goes lower. Usually on these 10-year surrender charge schedules, the amount goes down to zero after that. But during this time, if you were to take out more than that 10% each year that they allow you to do, most people that I work with don't really need to do that. They'll just put money in and they need it for guaranteed income. And in that case, it doesn't matter. The MVA will never apply to you, and neither will the surrender charges. And that's why we always look at your situation. We make sure you have cash on hand for emergencies and other things so that you never have to deal with the MVA or the surrender charges. But let's talk about the MVA. How does it work? So when you buy an annuity, and for example, let's say it's a 5-year annuity, and let's say it's at 5%, okay? So you buy it at 5%. At the same time, that insurance company might go out and buy a 5-year bond matching the interest rate that they need to give you, okay? So maybe it's at 5%. So they are buying that. And then during that 5 years, obviously there's a surrender charge schedule. There's an MVA that could apply, market value adjustment, which basically means if the interest rates rise during that time and you decide to surrender anything above that 10%, let's say, or you decide to surrender the whole contract, you incur the surrender charges. Plus, if the interest rates have risen maybe to 6%, okay, now all of a sudden the insurance company has to get rid of it at a loss. And so a lot of times what they're doing is they're passing on some or all of that loss to you as the annuity holder. Okay, and it's not very much, but it's still something. So something with, if you got interest rates that are 5% and it's risen to 6%, and you decide to take all your money out during that time, then the MVA would apply, which means they have to liquidate their investment on their side, and they're incurring a loss. And that's why on your MVA adjustment, typically you'll have it on the negative side as far as not getting as much back. So remember that. Also on the flip side, though, if you were to buy an annuity right now, let's say it's 5%, okay, and let's say you got a 10-year annuity. Let's say 6 or 7 years down the road, you're like, you know what, I've been earning all this money. It's been nice, and my account's been growing, but now I just want to surrender the whole thing. So I don't mind paying the surrender charges, and interest rates have gone down. So right now, as of the time I'm making this video, interest rates are pretty high. So you can get annuities anywhere between 5 and 6%. So what if I were to buy an annuity right now, and then let's say 7 years down the road, I want to surrender it. If I did that, and let's say interest rates have gone down, let's say they've gone back down to like 2 or 3%. Now, all of a sudden, I'm going to have an MVA market adjustment that's in the positive zone. I'm going to actually make some money on that, and so will the insurance company, okay? So because what they're doing is now they're getting them at a discount, and they're able to give you that growth as well. So they're being fair on both sides. When you're putting money into an annuity, you're typically doing it for a long-term investment. You're doing it because, everyone who buys an annuity, they're not looking at surrendering it. They're not looking at having to deal with surrender charges or market value adjustments, but life happens. And so because of that, the insurance company is also trying to protect themselves from losses as well. So just think of it like this. You buy an annuity and the interest rates go up, then it gives you a negative impact on your account's value, okay? If you buy an annuity when the interest rates are high and then you surrender it, and you surrender the whole thing before the surrender charge schedule is up, and the interest rates are down, then you're going to have a positive effect on your account balance, okay? So just think opposites. So right now we're in a high interest rate environment. If I were to buy an annuity right now and interest rates fall, I know the MVA is going to affect me in a positive way. But if I bought an annuity 5 years ago and interest rates, as we know, were super low, 2%, 1 or 2%, if I were to surrender it now, 5 years from now, with really, really high interest rates, now the insurance company would incur a loss, and I'm going to have some of that passed to me as the annuity holder. So again, when you think about purchasing annuities, you have to think about the end result. Okay, is this money that you can let sit in there for the term? Okay, whether it be a MIGA annuity where the term is maybe 5, 6, 7, 8, or 9, or 10 years. Okay, if you put the money in there, plan on leaving it there. Don't touch it. Let it grow, let it compound. And if you do want to touch it and you want to take money out, just make sure you do it at whatever that contract's rules are. So if it's maybe interest only, you can take that out every year. Or if it's up to 10%, then fine. If you want to do that, go ahead and do that. But as long as you do that, you're never going to incur surrender charges. You're never going to have to deal with a market value adjustment, right? So you'll be fine. And the same goes with fixed index annuities. If you're putting that money in there for growth and for guaranteed income later on, make sure you have money on the side, plenty of savings on the side. So if you need it, you can dive into that and not into your annuity. And if you do that, you're never going to have to deal with it. So it really just depends on what your goals are. If you want guaranteed income, you want long-term peace of mind, as far as having enough retirement income to deal with longevity risk, living too long, or if you just want a fixed annuity that's going to give you a growth for a certain amount of time, make sure when you get into these contracts that you have enough money on the side. So if you need to dive in to it for whatever reason, that you have it, and that you don't affect any of your earnings or any of your net with maybe a negative MVA. So anyways, I hope that was helpful. I know this can be a little complex to think about. So if you want to book a call and you're interested in maybe purchasing an annuity for yourself and you're looking for growth, maybe you're looking for income, let's chat. So happy to talk with you. Just book a call on my calendar. You'll see a link down below this video, and we'll talk for about 30 minutes. I'll answer your questions. Won't try to sell you anything. I'm happy to help you though if you are looking for the best annuities out there. I love showing you everything that's out there. So anyways, hope you have a great day. Look forward to chatting with you soon.